Good day. Ever wondered how ETFs actually make you money? Today, let's break down the two main ways, dividends and growth, using simple stick figure animations and real Aussie examples. First up, what's inside an ETF? In Australia, most ETFs are baskets of top ASX companies like banks, miners, and retailers. When you buy an ETF, you're buying tiny pieces of all these companies at once. Let's talk dividends. Many Aussie companies pay out part of their profits to shareholders as dividends. When you own an ETF, you get your share of these dividends, usually paid quarterly. Some ETFs focus on high-yield companies, so you can earn regular income, plus benefit from Australia's unique franking credits, making those dividends even more tax-effective for locals. For example, the Vanguard Australian Shares High Yield ETF, VHY, recently paid a yield of about 4.9% per year, distributed every 3 months. That's real, passive income landing in your account. The second way ETFs make you money is through growth. As the value of the companies inside your ETF rises over time, so does the price of your ETF units. This is called capital growth. Over the long term, the Australian share market has delivered solid growth, helping your investment grow in value. Put simply, dividends equals cash payments from company profits. Growth equals the increasing value of your ETF units. Many ETFs let you reinvest your dividends automatically, buying more ETF units and compounding your returns over time. This is called a dividend reinvestment plan, or DRP. Remember, ETF returns can go up and down with the market, and dividends may vary each year. This video is for education only, not financial advice. Always do your own research or talk to a licensed advisor before investing. If you found this helpful, give us a thumbs up, share your ETF questions in the comments, and subscribe for more Aussie ETF guides. How do you use your ETF income? Spend it or reinvest? Let us know below.